Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Synaptics Incorporated quarterly report. Synaptics Incorporated offers a wide range of semiconductor products for various applications. These include touch, display, biometrics, voice, audio, processor, wireless, and multimedia products for mobile devices, personal computers, smart homes, industrial equipment, and automobiles. The company's product portfolio also includes modular development kits, open software frameworks, and optimized AI/ML toolchains to support the development of innovative technologies. Additionally, Synaptics provides various connectivity solutions such as Wi-Fi, Bluetooth, Zigbee, Thread, Matter, GPS, GNSS, ultra-wideband, and ultra-low energy solutions. The company's human interface products include fingerprint ID technology, natural ID, which is used in notebook computers, personal computer peripherals, automobiles, and other applications. Synaptics also offers integrated touch and display technologies, local dimming, and driver sensing technologies to enhance user experience. Furthermore, the company provides various ICS integrated circuits, such as DisplayLink graphics, video interface ICS, fax/modem/printer processors, and display driver ICS, DDIC. These products are designed to simplify connectivity to external displays and provide high-quality visual experiences. Unfortunately, I don't have access to the text you provided. However, I can still provide a general overview essay on what could cause Synaptics Inc.'s stock price to increase in the past year. Synaptics Inc., a leading developer of human interface solutions, has seen its stock price rise significantly over the past year. Several factors may be contributing to this trend. One possible reason is the growing demand for touch-based technologies, which Synaptics specializes in. As more devices become equipped with touchscreens and gesture recognition capabilities, the company's products are becoming increasingly essential. Another factor that could be driving up Synaptics' stock price is its expanding presence in emerging markets. The company has been actively pursuing partnerships and collaborations with major players in these regions, which may lead to increased sales and revenue growth. Additionally, Synaptics' focus on innovation and research and development, R&D, may also be paying off, as the company continues to introduce new and improved products that meet evolving customer needs. Furthermore, Synaptics' strong financial performance over the past year may also be contributing to its rising stock price. The company has reported steady revenue growth, expanding margins, and a healthy cash position, all of which are positive indicators for investors. As the technology sector continues to evolve, Synaptics is well-positioned to capitalize on emerging trends and opportunities, which could further drive up its stock price in the future. Synaptics Incorporated market capitalization of $3 billion is materially smaller than most of its industry peers of roughly $27 billion. Synaptics Incorporated trades at a lower price-to-book ratio of 2.51 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 46% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The company has consistently reduced its share count, reflecting a shareholder-friendly approach to capital allocation. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be attributed to several key factors. On the growth side, a significant increase in units sold and average selling prices has contributed to revenue expansion. The Broadcom transaction has also been a major contributor to revenue growth. Furthermore, higher license revenue from certain IP has added to the overall revenue increase. In contrast, revenue decline is primarily driven by decreases in units sold and average selling prices across various product categories. Specifically, enterprise and automotive product applications have seen a decline in units sold and average selling prices, while mobile product applications have experienced a decrease in average selling prices. Additionally, lower license revenue from certain IP has also contributed to the revenue decline. The core IoT product category has been a standout performer, with a 13.2% increase in revenue, driven by both an increase in units sold and average selling prices. In contrast, enterprise and automotive product applications have seen a decline in revenue, while mobile product applications have experienced a modest increase. Overall, these factors highlight the importance of diversifying revenue streams and managing product mix to drive growth and mitigate decline. The net income of a company has experienced a significant decline over the past year. In 2024, the net income was minus $21.3 million, but it worsened to minus $35.4 million in the first quarter of 2025, and further dropped to minus $14.8 million in the fourth quarter of 2025. The profit margins have also decreased, with a gross margin drop from 45.6% in the fourth quarter of 2024 to 43.7% in the same period of 2025. Similarly, the year-to-date gross margin fell from 46.3% in 2024 to 43.2% in 2025. The operating loss has increased, with a rise from minus $15.2 million in the fourth quarter of 2024 to minus $15.1 million in the same period of 2025. The year-to-date operating loss also worsened from minus $43.6 million in 2024 to minus $38.3 million in 2025. The reasons behind these changes are attributed to several factors, including the acquisition of assets and non-exclusive licenses that may have contributed to increased expenses. Additionally, there was an increase in amortization of acquired intangible assets, which partially offset the growth in revenue from licensing certain intellectual property. The company's debt level has undergone some changes over the past year. Initially, the total debt decreased from $850 million to $836 million. However, as of December 2025, the principal long-term debt obligations remain at $850 million, indicating a slight increase in debt level. In terms of interest expenses, there is no clear indication of a significant change. The interest expense for 2025 was minus $2.4 million, which is not a substantial amount. However, the total interest expense did increase from $0.6 million in 2024 to $2.6 million in 2025, suggesting a slight rise in interest expenses over the past year. The performance of various segments and regions in the market has been a mixed bag. In terms of segments, it is clear that certain areas have excelled while others have struggled. Enterprise and automotive product applications have been standout performers, indicating strong demand for these products in their respective industries. Similarly, core IoT product applications have also seen significant success. On the other hand, mobile product applications have underperformed, suggesting that this area may require additional attention or investment to improve its fortunes. Turning to regional performance, it is evident that certain markets have been more successful than others. China/Hong Kong and Taiwan have both performed well, indicating a strong presence in these regions for the company's products. In contrast, Japan has struggled, while South Korea has seen positive results. The United States, however, has also underperformed, suggesting that this market may require additional focus or resources to improve its performance. Overall, the data suggests that there are opportunities for growth and improvement across various segments and regions. Management's outlook for the company is optimistic, with a focus on streamlining resources and reducing operating costs through its restructuring plan. This effort will enable the company to execute its strategy of developing integrated solutions that cater to customer needs. The integration of audio, touch, and vision interfaces with embedded processing and wireless connectivity is expected to drive growth due to increasing units sold and average selling prices. Management acknowledges monitoring macroeconomic conditions, including international trade policies and tariffs, but does not anticipate a significant impact on near-term financial performance. However, they will continue to assess the long-term effects of these policies on both financial and operational performance. Looking ahead, management anticipates increased demand for wireless products in the second half of fiscal 2026, which is expected to contribute positively to growth. The company also expects to repatriate substantially all foreign earnings without a material impact on income taxes. This suggests that management is confident in its ability to navigate complex financial and regulatory environments while maintaining a strong financial position. Overall, management's strategy and outlook are centered around driving growth through innovative product development and efficient operations, while mitigating potential risks associated with macroeconomic conditions. The company has been actively engaged in share buyback activities, demonstrating its commitment to returning value to its shareholders. A significant stock repurchase program was authorized, allowing for the purchase of up to $150 million in common stock. During the 3 and 6 months ended December 2025, the company made substantial purchases under this program, with $36.4 million and $43.6 million respectively being spent on buying back shares. This effort has resulted in a total of 550.999 billion shares being repurchased, effectively reducing the number of outstanding shares. The return to shareholders through share buybacks is evident, with $36.4 million being returned to stockholders during this period. These actions demonstrate the company's focus on maximizing shareholder value and its willingness to invest in its own equity. Concerns about inventory buildup and supply chain disruption are valid due to several factors. One major concern is the constraints or imbalances in component parts, such as memory chips, which can impact customer development timelines and production schedules. This imbalance can lead to stockouts, delayed shipments, and ultimately affect business operations. Another factor contributing to these concerns is the influence of tariffs, trade policies, constrained availability, and pricing dynamics for certain memory components. These external factors can disrupt supply chains, making it challenging for customers and suppliers to navigate the complex landscape. As a result, inventory buildup and supply chain disruption are potential consequences that businesses must be aware of and prepare for. That concludes the financial summary for Synaptics Incorporated. Feel free to comment below, and I will be happy to answer them when possible.